Team, in this series, I want to talk to you about calculating the working capital peg in a private equity transaction. And to do that, we need to understand the difference between the accounting definition of working capital and the definition of working capital in the context of an acquisition, because there are very important differences. The accounting definition is pretty simple. For working capital or net working capital, it's simply the difference between a company's current assets, like cash, accounts receivable, inventory, etc., and its current liabilities. But in a transaction, the working capital adjustment revolves around a calculation of working capital that both parties must agree to. So let's walk through some of the primary differences between these two definitions. First, cash is excluded, whereas the accounting definition includes all working capital accounts. Here, cash accounts are excluded from the working capital calculation. And that's because most control equity transactions are structured on a cash-free, debt-free basis. This means that the seller is entitled to cash on the balance sheet and that the seller is responsible for debts owed by the company. So cash is out. Next, not all accounts are included. Both the seller and buyer will need to agree on which current accounts should be included for the purposes of the working capital calculation. You shouldn't ever assume that all current assets and current liabilities will be part of this sum. And as it relates to what's not included, the buyer and seller can agree to anything both parties find fair. That said, a list of common examples might include accrued tax liabilities, accounts related to ongoing litigation costs, lines of credit, notes payable, and the current portion of long-term debt. Third, certain balances can be excluded. Beyond the decision to include any individual line item, the buyer and seller may agree to include or exclude a certain amount of any particular account. The most common examples of excluded balances relate to accounts receivable, accounts payable, and inventory. For accounts receivable and accounts payable, this generally relates to extended accounts. More precisely, a buyer may want to omit all accounts receivable balances aged 90 days or more to avoid the risk that those customers do not end up paying, because that's cash that the buyer may not receive once the transaction closes, so why pay for it? It's better to just let the seller attempt to recover those sums. Additional common examples include obsolete inventory, because if you can't use it, why buy it? As we previously mentioned, accounts receivable balances over a certain number of days, and 90 days is common. And finally, accounts payable balances that are considered an obligation of the seller. Let's take a quick look at an AR aging schedule. If the buyer and seller agreed to exclude AR balances over 90 days, the working capital calculation would include a value of $8.3 million for accounts receivable, which is the $10 million minus the $1.7 million. The final difference is that working capital must be normalized. The seller and buyer will need to agree to a normalized level of working capital. For a stable company, a common example would be to take the average last 12 months of each working capital account. But how you work towards a normalized level of working capital will vary from one transaction to the next. The variables that most frequently influence this calculation are the company's rate of growth and exposure to seasonality. In the next video, we're going to look at this process in detail by exploring an example that involves heavy seasonality and comparing it to an example that does not. But otherwise, that's all for now. Thanks for watching.